Hey guys, David here. So today I wanted to have a look at the dollar cost averaging technique and find out if it is in fact the best way to enter crypto. I was going to compare it to a simple RSI technique on the daily where you just basically invest when it drops below the 30 mark on the RSI, which is actually a really good technique for investing in Bitcoin, or it has been in the past. So let's compare these two strategies. I just want to say that dollar cost averaging has massive advantages. It's always buying the dip. It's always getting your foot in the market, and it's got some pretty good advantages where using the RSI technique, you literally have to be checking the markets every single day. So let's have a look at these. I also want to point out that at the moment, the world is kind of in a little bit of turmoil. There's a crazy Russian gallivanting around who's kind of creating havoc with the markets and costing lots of people their lives. If you want to see a really, really interesting chart, have a look at the ruble versus the US dollar. It's kind of tanked, and that's pretty intense. Anyway, let's go have a look at the Bitcoin charts and see what we can see what we got. So first up, on dollar cost averaging, I want to take the period of the 4th of February 2018 through to the present, and I also want to compare it to the 4th of February 2018 to the 27th of December 2020. Why these two numbers? Well, let's have a look at the charts. 4th of February 2018 is basically about when Bitcoin drops below 50% retracement. So it's fallen below 50% from its all-time highs. It is firmly in a bear market. It's roughly where my first signal comes in. And why do I end around the 20th of December? Well, that's roughly where it takes its new all-time highs at $20,000. So if you want to logically stop investing, that's where you would stop. Dollar cost averaging, of course, it's clearly breaking out into a bull market, and you might want to put your money elsewhere from the dollar cost average standpoint. That's why I picked those two dates. So the strategy I'm using is the RSI drops below 30 on the daily chart and closes below 30. So on the first scenario, 4th of February through to present, it happens 11 times in 4 years. So it's not that frequent. However, from 4th of February to the 27th of December, it happens 9 times in 3 years. So it's a little bit more frequent, but you get the idea. It's not a frequent signal, and you would have to get every single one of these signals to compare with your dollar cost averaging technique. So the rules for my RSI entry technique is the RSI must fall below the 30 point. Right here, it drops down to 22.6 on this particular candle. So that would be an entry point. Here it drops to 26. Here it drops to, where's my mouse? 28.87. So these three are entry locations. If you're wondering what the green lines are, these are the Bitcoin halvings. I'll cover those later. So the first one, as you can see, it didn't happen till straight after the 2018 bear market, gone down close to 60-70% before it actually triggered. So it does give you deep entries in bear markets. If you have a look in the May crash back in 2021, it triggered after the initial crash and then just showed divergence. It didn't trigger again the whole way across, which would have been a good entry if you could hold with the potential of it crashing again. And it recently just triggered again. So this is the entry I'm using. The two periods. The second period does exclude the short period that finishes around the 20th, finishes in 2020, excludes these last two signals because I just thought it was logical, and I thought it'd be interesting to compare it that way. So let's see how much money actually went in. So I've labeled the full period as full and the short period as bear. So the bear finishes in the 20th of December 2020. Your total cost investing $100 every week, not a whole lot, is 21,300 over a period of 4 years, for roughly $5,000 a year. Not too bad. Gives you 2.2 Bitcoin. Whereas if you'd just done the short version, you would have invested 15,000 and come with 2.07 Bitcoin. As you can see, you would have earned a lot more in the bear market scenario, like at least per dollar. So that's a difference of $6,000, and you would have earned 0.14 more Bitcoin. Not exactly brilliant. Now, if you were to average all the costs, all the buy prices that you did over that period of time, you would have your average buy-in cost would have been $19,500, and your average bear buy-in price would be $8,600. So there's a huge difference. You're clearly getting more bang for your buck just by investing in the bear market. However, you could be missing out on the bull market. It's dollar cost averaging. It's better. I don't know. That's what this is about. So the amount of Bitcoin you bought per transaction for the average bull market is 0.01 Bitcoin, whereas in the bear market, 0.013 Bitcoin. Thought that was interesting. So what about if you use the RSI to buy instead of dollar cost averaging? However, I want to make a caveat here. If you are dollar cost averaging, chances are you are earning $100 a week from your paycheck, and you're putting your paycheck into every single week. It's the advantage of dollar cost averaging. You don't need all the money up front. So if you were to put $100 in here, and then every other week you would save your $100 until you found your next signal and you went all in on the next signal, that would give you something like 10 or 15 $100 before you went in here. Then you'd have something like 30 weeks here before you went in, and you'd have like 3 weeks before you went in for the next signal. So if you look at it carefully, you are saving and then adding in. Does that make sense? So you're not investing the same amount on every signal. You're accumulating the money that would have been dollar cost averaged in every week. And then when you see the signal, you sink all the money you saved straight in. So I'm just comparing it to that. Now I want you to notice something. For the entire full season, you had 11 signals. Your total cost is $21,300, right? You end up with 1.93 Bitcoin. That is less than 2.21 Bitcoin. You lost money by using the RSI technique over the dollar cost average straight technique. That blew my mind. That blew my mind. That was crazy. And your average buy price was $10,000. I don't know how this worked, but it did. And for the bear market, you end up with 1.67 Bitcoin as opposed to 2.07 Bitcoin. Sure, the amount of money you spent to do it is less, but you ended up with significantly less Bitcoin using these techniques. I thought that was a really interesting, mind-boggling scenario. But the second scenario I want to cover is, what if you knew there was going to be 9 signals or 11 signals, and you had all the money beforehand and you parceled it out in equal amounts. So every single signal received exactly the same amount in cash injection. Now the total for the entire period is $21,000 for the entire period, divided amongst 11. So without using dollar cost averaging and entering equal, the full period, you ended up with 11 Bitcoin. So it's $1,936 every signal. You end up with 3 Bitcoin. However, as you can, for the bear market, you only had 15,200 to make a easy comparison between the two. The average cost, the entry prices, the amount you put in every signal was 1,688. You know, 2.5 Bitcoin doing the 9 signals. But if you only invested in the bear market, you end up with 3.5 Bitcoin. Do you understand the difference between the three strategies? First one is dollar cost averaging $100 every week. Second one is you save your $100 until you see the signal, then you go all in. Third one is you know how much money you're going to invest over that period of time, and then you divide it up and you deposit it equally on every single signal. And the third way, the equal amount entries showed significantly improve the amount of Bitcoin that you actually had by 50%, which is kind of really cool. I also wanted to proof test this. So I also did it on Ethereum over the same period, and I also did it on Litecoin, because those two have survived 4 bear markets, 4 bull markets, are now into their second or third cycle. They're all proven coins. That's why I've picked these ones. And Litecoin has not performed that well this season, even though Ethereum's outperformed. So that's why I picked these 3 as kind of proof testing. Let's go have a look at Ethereum. So if you dollar cost averaged in Ethereum using exactly the same strategy, you ended up with 11 entries and 11 entries for the full and 9 for the bear setups. They're all roughly the same, but not exactly the same. Like in May of 2021, you did not get a signal, whereas for Bitcoin, you did get a signal for May 2021. You ended up with 2 signals in January 2022, where for Bitcoin, you only ended up with 1. So they're not exactly the same, but you do end up with the same number of signals. Now for Ethereum, if you added up your cost of $21,300 and divided it $100 every week, you ended up with 70.9 Ethereum. That's a lot of money. That's absolutely wild. I'm really annoyed at myself for not doing this. I kind of was a little bit. I was putting $40 into Ethereum every week for a long time, but which is the main reason I have 10 Ethereum at the moment. But oh no, oh dear. Now, if you only did the bear market finishing on the 20th of December 2020, you ended up with 2.5 less Ethereum. So it's not exactly a game changer. Either way, your average buy-in price for the full market was 1,021, and the average buy for the bear was 300. Now, for dollar cost averaging, where you're depositing the same amount, so you're saving and then you put in on the signal, how did it go? You got less Ethereum doing it this way using the RSI signal. You only end up with 62 Ethereum and 58 Ethereum for the bear market scenario. That's a lot less Ethereum. That's 8 less Ethereum, or 10 less Ethereum doing it this way just by going off the signals, which breaks my mind. I don't understand how that's possible. However, if you deposited equal amounts of Ethereum into the signals, all 11 signals, you'd have deposited $1,936 every signal. You'd have 98 Ethereum. So you would have 18 more Ethereum by following the RSI entries with equal deposits, rather than doing saving up and then depositing. If you had done only the low signals with the higher entry, you'd have 118 Ethereum. If we go into Litecoin, we see the same thing. So for the full market, you get 293 that's Litecoin, that's supposed to say Litecoin, 293. But if you had just gone off the signals, you'd have 152 Litecoin. That's massive. That's almost 50% less. I don't know, guys. Something's tripping me out. And like Litecoin, dollar cost averaging and ignoring the signals is clearly better. So I don't know what to make of this. Dollar cost averaging is winning by a lot. I did, however, want to look at something you might find interesting. So we have all these RSI signals. Say you had your $21,300 just sitting there and you decided to have a pot shot. Just throw it at one of the random signals and see what happened. Or you had the $15,000 you would have invested over the bear market. What would happen if you just thrown it at one of the signals? Well, let's have a look. The green ones, you would be ahead. The red ones, you would be behind. This is the full, that'd be the full section. This would be the bear market option. You have more chance of getting it right and coming out ahead by throwing all your cash at one of these signals than you do at the just dollar cost averaging in, which I thought was really interesting. Now, guys, I would love to know what's happening here. Something's breaking in my mind. Dollar cost averaging is seeming a lot more robust than actually following legit RSI signals. So I'm not quite sure what's happening. But if you invested in the depths of the bear market for Bitcoin, this is the Bitcoin one, you would have 6 Bitcoin. Okay, let's have a look at the RSI on the weekly time frame, right? Same signal, but only looking at the weekly. What happens with Bitcoin? If you'd throw in your 21,300 at that one signal on the weekly time frame, you would have had 6.67 Bitcoin. Now this signal has appeared once. It happened right here. It happened once in the past 4 years. If you'd bought on the RSI below 30 on that one signal, that you would have got the absolute bottom of the market. And on the previous cycle, it also happened once on the 12th of January 2015. Seems to happen every 4 years with the RSI on the weekly drops below 30. Same with Bitcoin, same with Ethereum, and same with Litecoin. It's an absolute unicorn signal which gives incredible results. It's almost worth saving for that signal. It's pretty wild. If you'd done it with Ethereum, you'd have 230 Ethereum. If you'd done it with Litecoin, you'd have 800 Litecoin. That just boggles my mind. So I guess my takeaway conclusion from this is the weekly RSI signal, if you ever see it, is an absolute gold mine of potential. An absolute gold mine of potential. That is the RSI weekly signal for when the drops below 30. It happened once right here on the 10th of December 2018. If you see that signal, buy, throw everything you have at Bitcoin or Ethereum. Just do it. It's insane. It's a really good signal. I am wondering if it's worth having a look at the layer ones like Solana or Avalanche and seeing if you see the same signal. It's something to think about. Something I'm going to think about. So there are a few problems with my analysis though, which I'm going to bring to light, okay? What I want to highlight is I started here in the depths of the bull market, depths of the bear market. You get completely different results if you started over here in the bull market. In fact, if you started in the bull market and waited till you got to the RSI signals, as opposed to dollar cost averaging, you come out ahead. Or if you decided to start at the Bitcoin halving, which was here, you would have missed all these RSI signals and all this really low dollar cost averaging area. You actually get different results. So let's compare those two. So from the 4th of February to the average purchase price was 19,000, you end up with 2.2 Bitcoin. If you start on the 5th of May, which was the halving date for Bitcoin in 2019, your average purchase price was 25,400 and you only end up with 1 Bitcoin. Now, if you'd done the RSI signals from the 4th of February to 2018 through to current time, you'd have 11 RSI signals and you'd own 1.9 Bitcoin. However, the RSI signals are from the 5th of May onwards. There were 7 of them, and you would now own 1.1 Bitcoin, meaning that you come out ahead using the RSI signals if you start from the 5th of May. And my analysis also suggested that you come out ahead using the RSI signals if you'd started in the 2017 bull market rather than 2018 bear market. Which means that if you're dollar cost averaging below a 50% pullback, well, no matter what signal you're using to buy below the 50% pullback to invest, you're actually investing at a really good time. In this blue box, if you invest in this blue box, you get less return. If you invest below this blue box, you get a really good return. It does not matter so much what signal you use below 50% drawdown, of 50% pullback from all-time highs. That's what I'm gathering from this. But let's compare these options, these 3 different methods. So dollar cost averaging versus using the daily RSI, using the weekly RSI. Dollar cost averaging is consistent, it's easy to do, and it's brain dead. It requires, you can do it all the time. Signals, you don't even need to worry about them because you'd set it up automatically from your bank account. And when there's a dip, you're still buying, so it requires nil bravery because you don't think about it. So big win for dollar cost averaging. However, for the RSI and the daily, you had 11 signals in 4 years. If you miss one, you get different returns. So yes, there is potential that you could get good return doing it. However, you're only getting 1 signal every 4 months and you're buying the dip, which means your bravery, like, I might chicken out. I know I might chicken out on those buys, or I might not have the cash available, so potential to lose. The RSI weekly, though the return is absolutely incredible, you are buying at the absolute bottom of the bear market. There's a signal once every 4 years. Are you that brave? And can you look at the charts consistently for 4 years to be able to find that one signal in the RSI on the weekly time frame where it actually drops below 30? That's my thoughts, is that dollar cost averaging is the easiest to do and gets good consistent results, whereas aiming for an RSI on the weekly, though it gives you incredible results, is easy to miss. You might not look at the charts for a couple of months because it's in a bear market and it's boring and it's not doing anything, and you miss this signal. That's what's going through my head. So, but that also makes me think that it's worth having cash on the sidelines in case you see the RSI weekly trigger. but you should dollar cost average the rest of the time. So for me, dollar cost averaging is very easy, best done in a bear market. And what I want to do is when I see a bull market, I actually reduce my dollar cost averaging and save money waiting for a market retrace to buy. The RSI gives you good sniping entries, the weekly time frame giving you incredible sniping entries, but you have to be there to see them. There you go, guys. I found this really eye-opening. I hope you guys find it also really eye-opening that, yeah, just dollar cost averaging in is actually a very valid way to find entries in the markets. And trying to find other techniques involving the RSI and stuff might not be as profitable as I first thought or hoped. So yeah, like I like the idea of putting money aside to snipe, but I enjoy looking at the markets just as well. I put a lot of effort into this one, guys, lots of maths. Went finding all the historical data, averaging it out, putting different prices in. It kind of blew my mind on what I actually did. So yeah, either way, guys, thank you very much, and I hope you enjoyed what I've done here.